Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the markets had a nice little rally on the Friday session above 200 points, and it went up 200 points, and we're still at the upper end of our trading range. And I think we're going to pull back from the upper end of the trading range and eventually retest the bottom of the trading range, which is at around 11,200. Okay, so I'm just going to point it out right here, 11,200. Why do I think this market will go down to this range? Okay, so why do I think the stock market will pull back all the way down to 11,200? Well, that's very simple. We're getting a nice little rally in the US dollar index, and we're also seeing the euro-US dollar continue to pull back. Remember, weakening euro means a stronger dollar index. A stronger dollar index is negative for the stock market. Let's not forget that the European-Japanese yen pair is also continuing to weaken. On Sunday, the European-Japanese yen pair has fallen by around 30 pips. That's not too bad. I mean, 30 pips it could be worse, but again, 30 pips is still 30 pips, and I think it could continue to go lower and eventually test the bottom area of around 103. Down right here, another 40 pips loss, another 40 pip loss on the European-Japanese yen. I wouldn't be surprised if it were to happen, and the main reason why I wouldn't be surprised is because these European institutions, or these European banks, wanted the European Central Bank. And don't get confused by my saying of the European banks and the European Central Bank. European banks are banks like Deutsche Bank, Credit Suisse, stuff like that, Lloyd Bank. Okay, European Central Bank is the bank of all banks in Europe. Essentially, the bank where all the regional banks store their money, I assume. And that's just a huge assumption. And basically, the European Central Bank is unwilling to lend to these governments. So why should any other bank or regional bank be willing to lend to the European governments if the European Central Bank is unwilling to bail out these governments? That's a real question to ponder, because essentially the European Central Bank doesn't want to promote what do you call it? Moral hazard. Because if the European Bank makes it easy for these governments to spend even more money, what's going to stop these governments from spending money at all? Because these European governments are borrowing a ridiculous amount of money, and if you give them an even bigger amount of money to borrow, and you give them a ticket to spend that ridiculous amount of money, what is going to make them stop? And the only thing that's going to make these European leaders stop borrowing a ridiculous amount of money, or these European governments stopping to borrow a ridiculous amount of money, is if the markets force them to and give them a real wake-up call. And that's really what the European Central Bank is trying to do, because they know at the European Central Bank that if they continue to lend money to these governments, that this situation becomes unsustainable, and these European banks or these European governments will default. Each and every single one of them will default, and that would be a much more catastrophic scenario than if they were to cut back their spending immediately. Immediately cut back their spending, immediately cut back their borrowing, and therefore addressing the issue right now before it becomes impossible to fix later. Well, again, that's kind of the solution I'm hoping for, but right now the Organization for Economic Cooperation think differently, in a sense, because right now every industrialized country in the world has to borrow $10 trillion in a single year in 2012. They have to borrow that money because otherwise they cannot pay back. They can't pay their bills. So what they're forecasting is that the European zone is going to borrow an extra incremental 10%. So they're going to borrow more money. They're going to increase their borrowing. They're going to lose the value of the euro. Euro is going to depreciate to a basket of currencies because the confidence in the European bonds have sunk, and therefore the value of the European bonds are dropping as well. So euro bonds are dropping, the value of the euro currency is dropping, borrowing is going higher, interest rates on those bonds are going higher, and the economy is anticipated to double dip into a double dip recession. So this is bad, because if the amount of borrowing is continuing to go higher, the value of the European currency is continuing to drop, the European bond market is continuing to sell off, and the double dip recession is going to happen anyway, at the very least these European governments could stop borrowing a ridiculous amount of money and therefore solve the issue permanently, or at least for the next decade, or not really the next decade, but for the next century, so that we don't have to run into this issue until perhaps the year 2090 or 2095, rather than running back into the same exact issue where we have to come back and ask the European Central Bank for another bailout 10 years down the road by perhaps 2019 or 2018. So again, the amount of borrowing has gone up, and the amount of spending therefore goes up as well. So and let's not forget, if these interest rates continue to go higher, as spending continues to go higher, these governments are forced to spend more money to pay off their obligations because the interest has gone higher. So this is really a losing situation for everybody until these guys figure out a way to solve their problem. Let's not forget the Germany 10-year Treasury bonds failed at a public auction, but Germany was having a hard time borrowing money, and they missed out on $5 billion. The German 10-year interest rates have gone up on Sunday. So again, if German interest rates are going higher, that means there's less confidence even in the German bond market with their AAA rating. So if the AAA rating isn't enough to keep people from selling bonds, I really got to question what will stop people from selling bonds. What's going to cause them to buy bonds? And the European Central Bank is unwilling to buy bonds. The prime rate has dropped to 1%. Therefore, that's a dollar strength trade, which I already mentioned. This is really what it all comes down to is deflationary in nature. We're going to get an economic recession. The value of the European currency is going to continue going lower. The value of European bonds are going to drop. Spending is continuing to go higher, and the percentage of borrowing is going to go higher unless these governments cut back spending, not in a way that they want to, but in a way that will actually deliver results. And if they cut spending in a way that would actually deliver results, you would have public outcry, because the amount of spending that would be cut and the amount of tax revenues that would have to be raised would end a person's political career. And not very many politicians are willing to end their political career so that spending can be cut enough so that we can create a longer-term solution. Silver. Silver has continued to devalue, and again, Sunday, silver dropped. Monday, silver is dropping. Again, no surprise. Deflation. Deflation is bad for commodities, particularly silver and gold, and therefore silver and gold are pulling back. Let's kind of examine the 5-day. Yes, even the gold chart is weak on the Monday trading session. Again, the main reason for all of this market behavior is that the ECB was unwilling to lend money. German 10-year interest rates are continuing to go higher. This is inflationary in nature for the euro, and this also implies dollar strength. Dollar strength implies gold and silver weakness, and therefore the volatility index should go higher because gold and silver are falling along with the stock market. The stock market is trading at the upper end of its range, and if you're a real asset manager, you always know that you want to sell your weakest assets at the top end of your range and reallocate your money towards your non-cyclical, less riskier assets. And therefore, you're going to see markets pull back because of all these underlying fundamental characteristics, and top that with the fact that you're at the top of a market and not at the bottom of a market. So there's no real reason for us to be buying stocks at all. Euro is weakening, dollar is strengthening, the underlying economics behind what's going on has weakened, and we didn't get a bailout. And because of that, I am bearish these markets, and I'm positioned to be so. That is it for me for today, guys. If you have any questions, leave a comment right below, and I'll have more for you in the weeks and months ahead. Take care.